Greetings, everyone. Scott Richardson and Dan Brown from Richardson Capital Management here to provide the economic and investment update for January 2022. Needless to say, it was a rough start for the financial markets as markets were down broadly during the month of January. Stocks suffered a swift and relatively severe pullback as the S&P 500 was down 10% at its low point, and the Russell 2000, which represents small cap US stocks, was down over 15% at its low point. Even harder hit were technology stocks, with many of them down over 20% during the month. So needless to say, across the board stocks were under heavy pressure during the first several weeks of the year, but fortunately the last 2 days of the month, stocks found some footing and rebounded a little bit to stabilize the returns for the month. Fixed income investments were down during the month as interest rates rose, and as a result, all parts of the financial markets were down. The key questions we want to address today are, what caused the recent sell-off, and what is our outlook going forward from here? With that, I'm going to turn it over to Dan to give us an update on both those points.
So a lot of the volatility was caused by the change in Fed policy that we learned first week of January. So we saw the release of the December minutes from the Fed meeting, and it indicated that the Fed was looking to react fairly quickly in pulling away their very accommodative monetary policies that have been in place for almost 2 years now. So just to recap where we are with monetary policy, Fed funds rate has been in a range of 0 to 0.25% for, again, almost 2 years, and the Fed's been buying bonds to the tune of about $120 billion a month. They've been paring the bond purchases back, and they expect to wind up the bond purchases completely, probably in March. And then they indicated they could start raising the Fed funds rate as early as March. And a lot of investors interpret this to mean that with inflation as high as it is, that they could raise rates maybe 4 or 5 times this year in quarter point increments. We think that might be a little bit too high as far as interest rate increases are concerned. Then investors also got a little bit scared because, again, the Fed's been buying bonds now for going on 2 years, and the amount of bonds that they have accumulated on their balance sheet has grown to over $8 trillion. And investors are concerned that the Fed could both start raising interest rates at the same time and outright selling the bonds from the balance sheet. And that would cause a little bit of turbulence throughout the year. But again, we think monetary policy overall is still in a good place for stocks. And as far as an outlook is concerned, again, we started the year with a fairly optimistic outlook on the stock market. As we wrote in our last investment letter, we think maybe modest single-digit gains are in store for this year. And we still think that's the case. Corporate earnings still coming in very strong. Companies have been able to deal with a higher level inflation and generally pass it along to consumers. And the consumer's in a good spot with a decent amount of money in the bank and savings, et cetera, and spending at a decent clip. So overall, I don't think our outlook is swayed at all by a little bit of volatility here in the first month. And we think that stocks can again post single-digit gains. And the outlook for fixed income remains challenged. We think interest rates deserve to go higher from here, which is tough for traditional fixed income investments that posted a slightly negative return last year. And we think the same thing could be in store for this year in 2022.
So to wrap things up, the month of January was an extremely tough start to the year for the financial markets. However, we think it was just a recent bout of volatility. We continue to maintain a positive outlook for the year, although we do expect volatility to continue as it becomes challenging at these inflection points when we're changing monetary policy from being very accommodative to try to normalize. So while we do expect positive returns, we do think there will be a fair amount of volatility during the course of the year. With that, we thank you for joining us. And as always, if you have any questions or concerns, please don't hesitate to reach out to us.